put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. When mathematics lied. They called it the future of money, a revolution that would free humanity from the corruption of banks, the tyranny of central control, the broken promises of institutions. By early 2025, over 400 million people worldwide had placed their faith and their life savings into cryptocurrencies. They believed in a dream sold to them by tech prophets and digital evangelists. That code was law, that mathematics couldn't lie, that decentralization meant safety. But in the shadows behind the blockchain, something far darker was taking shape. A systematic dismantling of trust so complete, so devastating, that it would shake the foundations of an entire industry. What happened in 2025 wasn't just another market correction. It was a confidence collapse that exposed the terrible truth. The very system designed to eliminate trust had become the perfect machinery for its destruction. This is a dark business story about the slow death of belief. January 2025 began like any other month in the cryptocurrency markets, volatile, unpredictable, electric with possibility. Bitcoin hovered around $70,000, a testament to the resilience of the digital asset class. Despite years of skepticism from traditional finance, Ethereum processed millions of transactions daily, its network humming with decentralized applications that promised to rebuild the internet itself. Retail investors, ordinary people from ordinary places, checked their crypto wallets with the same obsessive frequency as their social media feeds, watching their digital fortunes rise and fall with each passing hour. The dream was alive, pulsing through fiber optic cables, written in cryptographic certainty. But beneath the surface of this technological utopia, the machinery of theft was already in motion. On January 23rd, users of Bybit, one of the world's largest cryptocurrency exchanges, woke to a nightmare that would become this year's defining moment. Over $1.4 billion in Ethereum simply vanished from the platform's cold storage wallets, not through some sophisticated zero-day exploit or quantum computing breakthrough, through something far more mundane and far more terrifying. Compromised private keys, the very foundation of cryptocurrency's security model, the mathematical certainty that only you controlled your assets, had been shattered. Hackers had somehow obtained the digital signatures that granted access to Bybit's reserves, and in a matter of minutes, executed one of the largest heists in financial history. The theft itself was surgical in its precision. The stolen Ethereum was immediately funneled through a complex web of decentralized exchanges and privacy protocols, tornado cash, cross-chain bridges, liquidity pools designed specifically to obscure the trail of funds. By the time Bybit's security team understood what had happened, the money had already fragmented into thousands of wallets, bouncing across blockchains like light through a hall of mirrors. The transparency that crypto advocates celebrated, every transaction recorded forever on an immutable ledger, became a theater of public humiliation as millions watched the stolen funds move in real time, powerless to stop them. Ben Zhou, Bybit's CEO, appeared before the world with the haunted expression of a man watching his empire crumble. He promised full restitution to affected users, pledged cooperation with law enforcement, announced partnerships with blockchain forensics firms to trace the stolen assets. The words rang hollow, because every person watching understood the terrible mathematics. Recovering cryptocurrency from sophisticated thieves was nearly impossible, and even if authorities identified the perpetrators, they were likely operating from jurisdictions where extradition was a fantasy. The decentralization that made crypto revolutionary also made it the perfect crime scene. No borders, no oversight, no central authority to appeal to, when things went catastrophically wrong. The Bybit hack should have been an isolated incident, a black swan event that the industry could compartmentalize and move past. It wasn't. It was the opening act of a systematic unraveling. Throughout February and March, the attacks continued with metronomic regularity. Femex lost $97 million to similar cold wallet compromises. Coinbase, the largest and supposedly most secure exchange in the United States, reported unauthorized access to customer accounts despite its two-factor authentication protocols. Smaller platforms hemorrhaged funds weekly, 10 million here, 30 million there, a relentless drumbeat of theft that began to feel less like isolated attacks and more like a coordinated campaign. Each hack followed a similar pattern: sophisticated social engineering, compromised internal systems, stolen private keys, and the same vanishing act through decentralized protocols designed to protect privacy, but weaponized to ensure impunity. The business crime documentary unfolding in real time revealed something that crypto's most fervent advocates had spent years denying. The technology itself was only as secure as its weakest human element. All the encryption in the world couldn't protect against employees who fell for spear-phishing campaigns, executives who reused passwords, or insiders who could be bribed or blackmailed. The promise of trustless systems, where code replaced the need for trust in institutions, had created something worse: a system where trust was absolutely required, but impossible to verify. By April, the cumulative losses had exceeded $4 billion, but the financial damage was merely quantifiable. The psychological damage ran far deeper. Sarah Chen had invested her entire retirement savings, $200,000 accumulated over 23 years as a dental hygienist in Portland, into what she'd been told was the safest cryptocurrency investment vehicle, a yield-bearing stablecoin platform called Meridian Finance. The returns were modest but consistent, 8% annually, backed by what the platform claimed were low-risk DeFi strategies and over-collateralized lending. The marketing materials featured testimonials from thousands of satisfied users, audit reports from blockchain security firms, and the smiling faces of founders who spoke at conferences about financial inclusion and democratizing wealth. On March 15th, Meridian Finance's smart contracts were exploited through a reentrancy attack, a well-known vulnerability that should have been caught in any competent security audit. The platform's entire treasury drained in 47 minutes. Sarah's retirement vanished along with the savings of 60,000 other retail investors who had believed in the billionaire secrets of crypto wealth. The founders expressed their deepest regrets in a Medium post, explained that they too had lost money in the attack, and quietly dissolved the company within a week. No criminal charges were filed. No restitution was offered. The audit firms that had vouched for the platform's security removed the reports from their websites and continued certifying other projects. Sarah's story was replicated millions of times across the globe in 2025, each iteration a small tragedy that collectively represented something unprecedented: the real-time destruction of an entire asset class's credibility among ordinary people. But if the hacks were the industry's body blows, the scandals were its death by 1,000 cuts. What the cryptocurrency industry didn't want the public to understand was that the hacks weren't random at all. Behind the scenes, a pattern had emerged that blockchain forensics teams were desperately trying to keep quiet. Many of the largest thefts in 2025 showed signs of being inside jobs or sophisticated social engineering campaigns that specifically targeted exchange employees. The Lazarus Group, North Korea's state-sponsored hacking division, had evolved beyond simple malware attacks into something far more insidious. They were recruiting insiders, compromising supply chains, and exploiting the trust networks that crypto companies relied on. Intelligence agencies estimated that North Korea had stolen over $3 billion in cryptocurrency in 2025 alone. Funds that directly financed the regime's weapons programs and enabled it to evade international sanctions. The decentralized revolution had inadvertently created the perfect money laundering system for rogue nations and criminal enterprises. And this revelation, when it finally leaked to major media outlets in late May, obliterated what remained of crypto's moral high ground. The money and greed that had built the industry was now literally funding nuclear weapons development. The scandal that broke this story open centered on a relatively unknown exchange called Nexus Trade. FBI investigators discovered that one of its senior engineers had been selling access to the platform's internal systems for over 18 months, providing North Korean hackers with the architecture diagrams and security protocols needed to execute precision attacks. The engineer, a 42-year-old programmer from San Jose who'd worked at 3 different exchanges over 5 years, had been paid in Monero, an untraceable cryptocurrency, and had enabled thefts totaling over $600 million. His arrest in June sent shockwaves through every cryptocurrency company. If it could happen at Nexus, it could happen anywhere. Trust in the security of centralized exchanges, already fragile after months of hacks, shattered completely. But users fleeing to self-custody solutions discovered that decentralization offered no sanctuary either. The rise of sophisticated phishing attacks in 2025 represented an evolution in cryptocurrency theft that exploited human psychology rather than technical vulnerabilities. Scammers created perfect replicas of popular wallet interfaces, MetaMask, Ledger Live, Trust Wallet, and distributed them through compromised Google ads, fake Twitter accounts, and even legitimate-looking App Store listings. Users who downloaded these malicious applications would see their familiar wallet interface, enter their seed phrases for what they thought was routine verification, and unknowingly hand over complete control of their assets to thieves halfway around the world. The scale of these operations was industrial. Criminal syndicates in Southeast Asia ran call centers employing thousands of workers who posed as customer support representatives for major cryptocurrency platforms. They worked from scripts, targeting people who posted about crypto problems on social media, offering help that led to sophisticated schemes where victims were convinced to share screen access or install remote desktop software. By the time victims realized they'd been scammed, their wallets were empty, and the criminals had vanished into the labyrinth of decentralized finance. The financial mystery that investigators couldn't solve was how these operations coordinated so effectively across borders, languages, and jurisdictions. Evidence suggested that former employees of legitimate cryptocurrency companies were selling their expertise to criminal networks, teaching them the psychological vulnerabilities of crypto users, the technical details of wallet architectures, and the social engineering tactics most likely to succeed. The corporate scandal brewing beneath the surface was that some exchanges were aware of this brain drain into criminal enterprises, but said nothing, fearing that disclosure would damage their already battered reputations. By summer 2025, the cryptocurrency industry faced a crisis of legitimacy unlike anything it had endured before. The 2022 collapse of FTX had been devastating, but ultimately contained. The fraud of one charismatic founder and his inner circle. This was different. This was systemic, persistent, and seemingly unstoppable. Every day brought new reports of stolen funds, new revelations of security failures, new examples of how the technology that promised to free people from institutional corruption had instead exposed them to theft on a scale traditional banking had never seen. The data told the story with brutal clarity. In January 2025, retail investors accounted for 43% of daily cryptocurrency trading volume. By August, that number had plummeted to 18%. Ordinary people were leaving the market in droves, no longer willing to accept the risk that their investments could disappear overnight through hacks, scams, or platform failures. The wealth and power that cryptocurrency had promised to redistribute was instead being systematically extracted by sophisticated criminal networks operating with near impunity. The industry's response revealed everything wrong with its culture. Rather than acknowledge the fundamental security failures, cryptocurrency executives doubled down on victim blaming. Users who lost funds to phishing attacks were told they should have been more careful, should have verified URLs more thoroughly, should have used hardware wallets and air-gapped computers and military-grade operational security. The burden of security had been transferred entirely to individuals, many of whom lacked the technical sophistication to understand the risks they were taking. Conferences still featured panels about financial inclusion and banking the unbanked, even as millions of those same people were being systematically robbed by an industry that prioritized growth over safety. The cognitive dissonance was staggering. Cryptocurrency advocates continued to argue that the technology was superior to traditional finance, even as their own platforms hemorrhaged billions to hackers. They claimed regulation would stifle innovation, even as the lack of oversight enabled industrial-scale theft. They preached decentralization while running centralized exchanges that controlled users' assets and could freeze or lose funds at will. The entrepreneurship secrets they sold through courses and coaching programs conveniently omitted the part where most retail investors lost money and criminal networks got rich. But the darkest revelation came in September, when leaked internal documents from 5 major cryptocurrency exchanges revealed that senior management had known about critical security vulnerabilities for years and chose not to fix them. The business thriller playing out in boardrooms from Singapore to San Francisco exposed a calculated decision. Investing heavily in security was expensive and reduced profitability. While the cost of occasional hacks could be absorbed through insurance, investor bailouts, or simply by making users whole with newly minted tokens, the real-life business story that emerged from these documents showed executives running cost-benefit analyses on customer security, literally calculating whether it was cheaper to pay for robust protection or to compensate victims after inevitable breaches. In every case analyzed, they chose the latter. The stock market secrets of crypto companies revealed that firms prioritized spending on marketing and celebrity endorsements over cybersecurity infrastructure. Millions spent on Super Bowl advertisements and Formula One sponsorships, while security teams operated with skeleton staffs and outdated tools. The rise and fall of retail investor trust wasn't an accident. It was the inevitable consequence of an industry that had optimized for growth at any cost, including the safety of the very people it claimed to serve. The leaked documents sparked investigations across multiple jurisdictions. The Securities and Exchange Commission launched probes into whether exchanges had misrepresented their security capabilities to investors. The Commodity Futures Trading Commission examined whether platforms had violated their duty of care to customers. International regulators coordinated actions against companies that operated across borders, exploiting regulatory arbitrage to avoid oversight. But by the time these investigations bore fruit, the damage to retail investor confidence was complete and possibly irreversible. The psychological aftermath of 2025's cascade of failures created what behavioral economists were calling crypto PTSD, a deep-seated fear and distrust of digital assets that transcended rational analysis. People who had lost money weren't just avoiding cryptocurrency. They were actively warning friends and family to stay away, sharing their horror stories on social media, creating a viral counter-narrative to the industry's promotional machinery. The network effects that had driven cryptocurrency's adoption in the 2020s were reversing, creating a spiral of declining participation and evaporating liquidity. Traditional financial institutions watched this collapse with barely concealed satisfaction. For years, they'd been mocked by crypto evangelists as dinosaurs, gatekeepers of a broken system destined for obsolescence. Now they could point to 2025 as vindication of their conservative approach. Yes, banks charged fees and moved slowly, and required extensive documentation. But they also offered FDIC insurance, regulatory oversight, legal recourse when things went wrong, and security infrastructure built over decades. The very intermediaries that cryptocurrency had promised to eliminate suddenly looked prudent rather than parasitic. The lessons about power that emerged from 2025 were harsh but necessary. Cryptocurrency hadn't decentralized power, it had simply transferred it to new elites, exchange operators, large token holders, and criminal networks sophisticated enough to exploit the technology's vulnerabilities. The lessons on greed were even more pointed. An industry built on the promise of democratizing wealth had instead created new mechanisms for extracting it from ordinary people and concentrating it in the hands of those with technical expertise and moral flexibility. The psychological insights cut deepest of all. Cryptocurrency's appeal had always been emotional rather than purely rational. The allure of getting in early on a revolution, the fear of missing out on generational wealth, the desire to believe in an alternative to systems that seemed rigged against ordinary people. Scammers and hackers understood these psychological drives better than the legitimate industry did, and they exploited them ruthlessly. Every promise of easy wealth, every celebrity endorsement, every influencer promoting the next big coin fed into vulnerabilities that made people susceptible to theft disguised as opportunity. The strategy and manipulation employed by both criminals and legitimate cryptocurrency companies relied on the same playbook: create urgency, promise exclusive access, leverage social proof, and exploit the human tendency to trust without verification. The only difference was that legitimate companies added regulatory filings and audit reports to the mix, creating a veneer of credibility that often proved just as hollow when tested. By October, the business scandal documentary of 2025 had written itself through billions in losses and millions of shattered dreams. The cryptocurrency industry's market capitalization had declined 47% from its January highs. But the real measure of destruction wasn't in the charts. It was in the trust that might take a generation to rebuild, if it could be rebuilt at all. Some exchanges responded to the crisis with genuine reform. They implemented proof-of-reserve systems, allowed independent audits, invested heavily in security infrastructure, and created compensation funds for hack victims. But these efforts felt reactive and insufficient. Band-aids on a system bleeding from multiple wounds. The fundamental architecture of cryptocurrency, trustless, pseudonymous, irreversible, made it exceptionally difficult to protect unsophisticated users from sophisticated threats. Other companies simply doubled down on opacity. They moved operations to friendlier jurisdictions, obfuscated their corporate structures, and continued operating much as they had before, betting that greed would eventually override fear and bring retail investors back to the table. History suggested they might be right. People had remarkably short memories when money was to be made, but something felt different about the 2025 collapse. The scope, the persistence, the systematic nature of the failures had created a moment of collective clarity about the true nature of cryptocurrency's risks. The danger of unchecked ambition, both technological and financial, had never been more apparent. Cryptocurrency's builders had moved fast and broken things, and what they'd broken included the financial security of millions who could least afford the loss. The hidden cost of success for the industry's winners was measured in the ruined lives of retail investors who'd believed the promises and paid the price. By year's end, think tanks and academic institutions were producing detailed postmortems on 2025's confidence collapse. They identified multiple contributing factors: inadequate regulation, insufficient security investment, perverse incentive structures, poor user education, and the inherent vulnerabilities of a technology that prioritized censorship resistance over consumer protection. But beneath all the technical analysis lay a simpler truth. Trust is hard to build and easy to destroy, and cryptocurrency had systematically destroyed what little trust it had accumulated over the previous decade. The regulatory response that began taking shape in late 2025 promised to fundamentally reshape the industry. Requirements for proof of reserves, mandatory insurance for custodial services, criminal background checks for exchange operators, strict capital requirements, and enhanced customer protection standards would make operating a cryptocurrency platform more expensive and complex. Industry advocates cried tyranny and predicted an exodus of innovation to less regulated markets. But for the millions who'd lost money in 2025, these measures came far too late to matter. The true believers, and they still existed, diminished but defiant, argued that 2025 represented birth pangs rather than death throes. They pointed to the internet's early history, the dot-com crash, the subsequent recovery and transformation into the backbone of modern life. Cryptocurrency would follow the same arc, they insisted. The weak projects would fail, the scammers would be weeded out, and what remained would be stronger, more legitimate, more worthy of trust. Perhaps they were right. Perhaps 2025 would eventually be remembered as a necessary correction, a painful but productive purging of the industry's worst elements. Perhaps the technology's fundamental promises, financial inclusion, censorship resistance, programmable money, would ultimately prove valuable enough to justify the costs of getting there. But for Sarah Chen, checking her empty retirement account in November, such abstract possibilities offered no comfort. For the 60,000 other people who'd lost everything in the Meridian Finance collapse, the future of cryptocurrency was irrelevant compared to the immediate crisis of financial survival. For the millions of retail investors who'd watched their savings evaporate through hacks, scams, and platform failures, the industry's promises rang hollow against the reality of their losses. The confidence collapse of 2025 wasn't just about money. It was about the gap between what had been promised and what had been delivered, the difference between the utopian vision of financial freedom and the dystopian reality of industrial-scale theft. It was about ordinary people who'd believed in something revolutionary and discovered too late that revolution often devours its most faithful adherents. As the year drew to a close, cryptocurrency trading volumes continued declining, liquidity evaporating, and retail participation cratering. The billionaire secrets that influencers had sold through courses and coaching programs were revealed to be either survivorship bias or outright fraud. The corporate scandals that had defined the year gave way to an eerie quiet as companies shuttered operations, executives resigned, and investors wrote off losses that ran into the hundreds of billions. The machinery of cryptocurrency ground on, blocks still being mined, transactions still being processed, believers still believing. But something fundamental had shifted. The narrative that had powered the industry's growth, that cryptocurrency represented inevitable progress, a superior alternative to corrupted traditional finance, had been tested against reality and found catastrophically wanting. In the end, the story of cryptocurrency's 2025 confidence collapse was a story about trust itself, how it's earned, how it's lost, and whether technology alone can ever truly replace the human judgment and institutional safeguards that trust requires. The industry had bet everything on the idea that code could replace trust, that mathematics could substitute for regulation, that decentralization could eliminate the need for intermediaries. They were wrong. And in the rubble of that failed experiment lay billions in stolen wealth, millions of broken promises, and the shattered faith of an entire generation of retail investors who had believed in digital gold and received digital ash. The revolution they'd been promised had arrived, just not in the way anyone expected. It was a revolution in theft, in systemic failure, in the dark side of what happens when technological utopianism collides with human nature's oldest sins: greed, deception, and the ruthless exploitation of trust. The future of money, it turned out, looked a lot like its past. Only this time, the victims couldn't even see the faces of those who'd robbed them. They could only watch the numbers in their accounts drop to zero and wonder how they'd ever believed that trustless could mean safe, that decentralized could mean secure, that the absence of oversight could mean anything other than the freedom to steal without consequence. The dream that began with promises of liberation ended in 2025, the way such dreams always end, with those who believed most paying the highest price, and those who never believed at all walking away with pockets full of other people's money, hidden behind layers of encryption and untraceable transactions, laughing all the way to whatever bank would still take them. That is the dark business story of how an industry built on the premise of eliminating trust proved only that trust, once destroyed, is the hardest thing of all to recover, and some breaks once made can never truly be repaired. Subscribe and listen to our next story below.